Congratulations for taking ownership of your financial plan by tuning into the Federal Employee Financial Planning Podcast, hosted by Mason & Associates, financial advisors with over 3 decades of experience serving you.
Welcome to the Federal Employee Financial Planning Podcast. Tommy and I are so excited to bring a special guest on this episode, Broc Buckles from BC Brokerage. He's a co-founder of the firm and in charge of marketing. And this firm does really cool work. They work with fee-only financial planners like us to help our clients get the necessary life insurance they need in their financial plans. As a fee-only financial planning firm, we can't accept commissions or sell insurance products. Don't confuse the previous statement that we think commissions are bad or that we think insurance is bad. In fact, commissions and insurance are necessary in one of the most important parts of your financial plan. Nothing can blow up a good financial plan faster than being uninsured or underinsured. Although we don't sell insurance products at Mason & Associates, we align ourselves with companies like BC Brokerage, who we trust to help our clients. Insurance is a word most people don't want to hear, or when they hear it, they have a bad connotation. Everybody knows somebody that's been taken advantage of or feels like they've been taken advantage of from an insurance salesperson. Broc Buckles and his team is the opposite of that, and that's why we're excited to have them on the Mason & Associates Federal Employee Financial Planning Podcast. Folks, remember, unlike many content creators, we're financial planners first and we do this second. And each episode, we share real-life experiences from decades of helping federal employees. And always, we hope to help you understand the complexities of your benefits package and all areas of your financial plan. Tommy, Broc, welcome to the Federal Employee Financial Planning Podcast.
Thanks, man. That might have been one of the best intros I've ever heard, John. So good on you, man. That was great.
Well, thank you, sir. It's one thing we're trying to get better and better each time, right? It's like if you don't hook people at the beginning, they're going to tune you out before they listen to the meat of the podcast. So thank you.
Yeah, you bet. That was great.
Broc, it's great to have you here. And on the intro, I am chuckling because when we recorded the podcast with you, I think John and I walked away like, he did a pretty good job of that. We got to step our game up a little bit. So, friendly competition there.
There we go, man. I love it. Hey, we all push each other to get better, right?
Yes, great. We do. Well, Broc, before we dive into the podcast, why don't you do a little introduction for our audience? And keep in mind, it's a Federal Employee Financial Planning Podcast. We've got folks listening from across the country, everything from active clients to people who will never meet. So if you would, just introduce yourself as well as share kind of like what you and your team do for firms like us. And we see you all the time at these financial planning conferences. So I think it'll be good for our audience to hear what you guys do.
Yeah, absolutely. So again, Broc Buckles, Broc Buckles with BC Brokerage, which is a total mouthful. I even have a hard time saying it sometimes. But basically, we started an insurance brokerage when we saw a need in the market for fee-only financial planners. They do great work, right? But one of the things that we noticed early on was a huge pain point of theirs was being able to find a trustworthy insurance broker to go to that wasn't going to try to either one, steal their clients, or two, upsell their clients a bunch of stuff that they didn't need. And so we decided that we wanted to be that go-to solution. So we started here kind of locally in Indiana where I'm based. My business partner's in Miami, and then started growing. And now we work with fee-only financial planners in all 50 states. And so it's been a cool journey. On the personal side, married to my wife, Morgan, who's awesome. And I'm a dog dad for a dog named Milo. So that's a quick little blurb.
Yeah, Broc, thank you for the introduction on everything that you guys are doing. And can you share with the audience when did you start the firm?
Yeah, so we started it in a very interesting time to start a business. It was in January of 2020, right before COVID. So it was
wow.
Yeah. We were starting, and I was like, fantastic, right? Like we knew we were going to be virtual, but now we definitely knew we were going to be completely virtual. And so part of me thinks that actually kind of helped us grow because everybody was online and willing to take meetings and somewhat, I think, just looking for social interaction outside of what was going on at home. And so we started and just kind of got involved with our local FPA chapter, started slowly going to some conferences like XYPN. And so, it was a really fun start. but we were just kind of figuring it out. So 2021 things started to pick up a lot, and then after that, it's been a really fast growth.
I didn't know that we knew this, Tommy, coming into this podcast episode, but Mason and Associates in our current form, because we've been in existence, Brock, since like 2002 when Mike and Ken started the firm, right. And we were with a broker dealer, and we had the IAR designation, and we would help do insurance products and whatnot. But in September of 2020 is when we launched the fee-only RIA.
That's awesome.
So we actually launched this version of Mason and Associates, similar timing to when you launched BC Brokerage. And what's kind of cool about that is we were actually going to launch in March or April of 2020, but then the whole world ended, delayed our game a little bit, and we were able to come in the fall of that year. So I definitely understand. We understand where you're coming from. I mean, we were thinking that when our clients were going to leave the broker dealer and come with us, that we would like load up the cars with paper applications and drive to people's houses. But then the magic of DocuSign happened that year too, and we didn't have to do any of that.
Yeah, for sure, man. It was definitely a period of evolution where you just had to learn to kind of go with the flow, and that things weren't going to be the same as they always had been. So it's really cool to see how a lot of firms evolved and businesses evolved. And I think there's, as bad as that time was, and as much as everybody was ready to get out of it, I think there's a lot of growth and learning and evolution that came from it. So for that, I'm thankful.
Our big takeaway from that period was we were like 90% in-person client meetings before COVID, before 2020. And we've since flip-flopped to now we're like 90% virtual. And we've had whole podcast episodes on why we do that and how we do that and why we continue doing that. But the education experience is better. It allows us to meet with clients across the country. And, we could go on this tangent for a while, but what I think the coolest thing to happen from COVID is people Google search financial planner near me. Now they can search federal employee financial planner, and it doesn't matter how close they are to you in proximity or whether or not they're right next door, because you can just get the best of the best wherever they're located, which kind of is like what you guys are doing at BC Brokerage. Is we don't have to go to Insurance Joe down the street in Newport News or Yorktown. We can go to you guys, and people can use you throughout the country. So I think it's just brought a level of expertise and a level of enhanced client service that we didn't have before COVID, in my opinion.
Yeah, 100%. I mean, you just had to learn how you were going to do business. Like our goal was always be across the country, right? But when you say that out loud, that seems like a more daunting task than it really was. Really, once we got licensed in a few states and kept doing it, it was just replicating it. So it's a lot scarier in your head than sometimes it is to actually put into action. I think that's a good lesson.
Well, I can tell you one of my favorite things, and I did more of the insurance stuff, Tommy, than you did over the years, but one of my favorite things about being a fee-only RIA and not having to do sell any insurance or market any insurance is not having to worry about which carrier I'm appointed with or which carrier I'm not appointed with or which state I need to have an insurance license designation in or which ones I don't. Or if it's a term, that's one sort of appointment, but if you were to do an annuity, that's another. And it's just managing I don't know if that appointment process is still the same as it was 5 or 6 years ago, but, back in the day, we had like handwritten spreadsheets and like pins across the country on like where we're licensed, it was brutal.
Yeah, for sure. I mean, I'll tell you one thing, man. You better just be glad that you never got into the property and casualty side of things, the home and auto and all of that, because that makes the life insurance side look like a piece of cake with the appointments and stuff. So yeah,
I'm curious about that. So does I know I've actually asked you a property and casualty. Sorry, I was about to go to acronyms, but a property and casualty question before. You guys serve in that role as well?
Yeah, so we're doing that in all 50 states now. So depending on the state that you're in, obviously, we might have more or less carriers, right? Like if you're in California and in a place that's got, a high risk for a natural disaster or wildfire area or something like that, or, you're in Florida where you're hurricane prone in an area, it can be a lot more difficult. But in most states, we've got a lot of really good options, which has been a cool add-on.
Can you elaborate a little bit more on that? Because a lot of the people who are listening to this podcast, Brock, are probably military veterans or served in the military or have some pathway to USAA. And USAA is a fan favorite, but in our experience, the premiums have gone up quite a bit over time. Yep. People love USAA because they believe that they always pay and they don't give you the runaround as it comes to the claim process. I personally never had an issue with an insurance company paying, whether it's long-term care, DI, life, or PNC, property and casualty, or even automotive. So if you could just share a little bit on what carriers you guys are typically offering, either in your home state or Virginia, how you stack up against somebody like USAA, and maybe why somebody should get out of their comfort zone and maybe ask you guys to shop this for them.
Yeah, absolutely. So we've got a lot of, Safeco, Allstate, a lot of the main carriers that you're going to be thinking about. But as a general rule of thumb, you should never just rely on one, because what we find is there's kind of this sneaky little trick. And what a lot of people don't know is your premiums going up is usually a result of the loss that the insurance company took the year before, right? That they're trying to make up the money from. And so, it went up $30 a month this year, and then that happened next year, and then that happened. So now you're paying $1,200 more a year or whatever it is, and you're just thinking, well, this is happening across the board, right? But you're not necessarily thinking, maybe I should go get this checked out. And oftentimes what we see is that can result in literally people saving thousands of dollars of companies that are willing to, accept more risk in that market. And so it's just a really good idea to work with a broker and shop things out and look at more than one option, because one person or one company is never going to be the answer. You definitely want the entire picture, and someone that's going to send that out to, 4, 5, 6, 10 different companies and see if there's a better rate out there that you can get.
Can you tell us a little bit more? And Tommy, I don't know how you feel about this, but at least me personally, I use a firm over in Virginia Beach that kind of similar, Brock, to what you guys are doing at BC, is that they've got Safeco and, Travelers at one point. I don't know if they're still using them or not. And
yep.
Even for me, it's kind of hard to get out of my comfort zone and go back to this firm and say, can you rerun these policies for me? Can you reshop it for me? You have to reset up auto pay. You have to do all the things again, and then you have to fact check the insurance company or the brokerage house to make sure you're still getting all the things you wanted. But to me, it feels like every 2 or 3 years, you're probably needing to shop this coverage in a minimum if you want to always have a competitive premium. So I'm curious your thoughts on that. I'm also curious, your service level as it relates to property and casualty compared to, Joe at State Farm, who's down the street from us. Is it going to be better, the worse, the same?
Yeah.
Talk about that a little bit.
Good question. So number one, it's going to be better than Joe, because if Joe's a State Farm rep, he's only going to try to sell you State Farm. So for anybody that's listening along, that's a good term to know, is captive versus broker. So when we say captive, that would mean like people that work at State Farm, and maybe they get you a competitive price, but they are selling solely State Farm, right? So if your rates go up or something like that, they might be able to get the price down, but that might come at the consequences of lowering limits or getting creative around, how they're designing those policies, which might mean if you have a claim, it's not going to be great for you, right? The other thing is I would say, check it at least every 2 years. But if you have a good broker, and the way that we do it is we actually have a system called Easy Links, where it's a P&C rater, property and casualty rater, or quoting software that proactively is always going to be checking on the best prices for you. So once your information is in there, it actually is going to be doing that on its own, which is great. Technology is wonderful. And so we're actually able to reach out on a yearly basis when that renewal is coming up to let the client know if there's going to be a better option out there. And so if they're getting a letter in the mail saying that your premium's going up by 30%, we can say, don't worry, we're already thinking about it. We got you covered, and help them get a better rate there.
Well,
That's not a service that I'm getting. Yeah. I can tell you that.
I definitely like the technology aspect of it. We're big fans of technology, and I have kind of picked up on that from interacting with your firm, Brock, that you guys are certainly utilizing technology to make it more efficient. I'm curious, you probably use some judgment, if I had to guess, right? So Easy Links says, hey, it's going up. And do you then say like, well, the other companies have these trade-offs, and like John said, a client's now got to go through setting up all these, auto pays again, where it's just not worth the hassle. But hey, client, maybe like this is on our radar, and if it gets worse, we've got some other solutions.
Yeah, absolutely, man. I mean, it kind of comes and goes, right? Under different leadership, different companies are sometimes their servicing departments are better, and then a new CEO comes in, they cut costs or something, and then you're waiting on hold for 30 minutes instead of getting right to somebody when you need to call them and change something. So, if I'm paying $15 or $20 more per month to be able to get somebody on the phone when I need it, that's a trade-off I'm willing to take all day long. So I think it's more than just looking at price. I think that when we talk to people about insurance, we want to focus on value. And value is not directly correlated with price. Price is obviously a point or a part of that. But we want to make sure that all around that client is getting the best experience possible, because when we deal with our own insurance, that's what we want to have as well.
So I didn't think we'd spend so much time talking about property and casualty, and maybe we'll switch back. But this is certainly part of the financial planning picture, and it's great to have a resource that can connect all of these pieces with us and our clients. What do you see, broad stroke, and I'm sorry if it's very vague, like as big misses or common mistakes in that world specifically? I know one that comes to my mind would be like an umbrella policy. I know we constantly are trying to get clients to look at those, but anything else, my mind's like thinking flood, just the different riders. Yeah. Any common mistakes you see besides not shopping frequently enough?
Yeah. So if we go down the home and auto or the home train, we're never going to move on to anything else. So I'll keep it simple and we'll do auto. But it goes for home too, right? And umbrella is a good point there, Tommy. But what I would say is just like the limits are terrible, right? So someone comes to me with like state minimum, right? They're like 50 and 100, meaning that like if you were to get in an accident, anything over $100,000, you become personally responsible for it, but because that's all they're gonna do. So if you're like driving your way through work, you get distracted for a second, or you're helping your kid in the backseat or whatever you're accidentally doing, and you rear into somebody, and they're driving a really expensive sports car, right? And it's going to cost more than $100,000 to fix. Now you become personally liable for that damage, right? God forbid you rear end them, they get neck pains or something happens, they have to go get surgery. Now you're responsible for their medical bills, right? So one of the worst things that you can do, and one of the easiest things to mitigate for a really inexpensive amount of money, is just get the proper limits. And with most companies across the country, it's going to be $250,000, $500,000 limits, and then get them at least $1 million umbrella policy on top of that. And you've really done a good job of insulating yourself so that you're not going to have to worry about some of those, minute details of, oh crap, I got an fender bender. Like, what am I going to have to pay for this now? That is great, Brock. I'm curious.
You mentioned that all sounds great. The umbrella, $1 million minimum. I think we certainly get on board with that. Where my mind is wondering is there a point where, like, how much umbrella coverage can we get, or at what point does this become more of like a customized quote where we gotta get more creative?
Yeah, so most companies up to $5 million, they're just gonna be like, yeah, sure, we'll write it as long as you've got the things that you need to back it, right? And you're willing to pay the premium. Once you get beyond that, sometimes we have to do kind of like stacking umbrella policies on top of each other, right? So maybe you've bundled one, you've got your home and your auto with a carrier, and then we'll do another policy with a different company that would be called a monoline policy or a standalone umbrella policy, which basically after you have gone through your umbrella, all your limits for your home and auto, and then your umbrella through the company that you currently have, you're able to tap into that next umbrella, right? So if you need a $10 million policy, we can likely get it for you. It just might be through more than one carrier.
And while, John, I know we want to move off of this, and I swear we will, it just dawned on me, we keep saying umbrella, umbrella, umbrella. perhaps everybody doesn't know what an umbrella policy is, and we should explain. So, Broc, this is your world. I imagine you can give a very succinct explanation of it.
I can make it quick, Tommy. So all it is an additional layer of liability coverage. So that means it's not going to take care of you, right? If you were in an accident or something were to happen, or you go beyond what your car costs, it's not for you, right? But what it is for is if you injure someone sues you, anything where people could kind of threaten your financial livelihood by trying to get in your pockets, it's an extension that doesn't allow that to happen. So think of it as a liability policy that's only for other people. That's as quickly as I can do it.
And do we call it like a secondary insurance, right? Or a co-insurance that kicks in after you've blown through the first limits, right?
You got it.
And you mentioned the limits a little bit, the 250 or 500. I wrote down penny wise, pound foolish, where, a lot of times we can over engineer or go into analysis paralysis and think like, well, I want the cheapest insurance, but just like we said in the introduction, is one of the quickest ways to blow up your financial plan is not signing up for health insurance for 2 years, rolling the dice and you have a heart attack, or signing up for the bare minimum state limits and then you rear end somebody because you're texting. And these things blow up a financial plan very quick. A premature death with no life insurance, all because we're trying to save $10, $50, $100 a month. So in order to have, I believe, that umbrella policy, most insurance companies will require that you have certain limits in place too, right?
Yep. And usually that's that 250, 500. Yep.
And then in my experience, if you're going to add the umbrella, you're typically doing your home, your auto, and the umbrella with the same company, right?
Yep. But it doesn't have to be. There are standalone options. So like if your company will not do it, there are options out there. But typically, it's more common to bundle them.
And I guess it's good for our audience to know, too, like for any of you that have toys, by toys, I mean motorcycles, RVs, boats, jet skis, trampolines, pools, Rottweilers. I know that's not a toy, but, the more risky things that you have, this does impact your premiums, both for home and auto as well as umbrella, correct?
Yeah, absolutely. You named a lot of the really good ones, John. I would also say if you're going to have somebody that's going to be a teenage driver anytime soon, go get it now.
Yes.
Because once they have their permit, a lot of companies will be like, yeah, we'll give it to you in like a year or two. Not while they're like permit drivers so that's an important thing to know too.
Well, I love what you said about, the value, right? We talk about insurance as a necessary thing. We talk about it. We know we have premiums. Nobody likes paying for things that they hope they never use.
Right.
You mentioned the value that you add by like constantly reviewing these policies for home and auto, every year through the technology. As we kind of move into the other areas of insurance, which include life insurance, disability, long-term care, can you share with us how does BC Brokerage, how do you all serve clients in an ongoing basis? Because a lot of your referrals are coming from people like us,
right?
Where we're doing the strategic planning meetings, we're reviewing with clients every year, hopefully their insurance needs. Maybe we do that better or worse than other firms, probably better, we would think. But how do you fit into that world, and what should clients expect from you? Annual policy reviews, beneficiary updates, if they need to change a beneficiary, like how do you guys get involved in all of those things?
Yeah, absolutely. So we have a system that I cannot take very much credit for. My business partner, Peter, is way better at that stuff. I always kind of joke and say, if you had 2 Broc Buckles at our business, you would meet a ton of people, and then maybe not everything gets done the way it should. So I'm thankful for Peter. But what we do is, we keep everybody up to date on what's upcoming and then answer any ongoing questions. So, 30 days before your policy is supposed to renew, before you're going to get billed for it, you're going to get an automated email update letting you know, hey, here's what you have coming up. Just a reminder, here's the type of insurance that you have. Here's how much you're paying for it every year. Here's how many years you have remaining. And then obviously there's ongoing service items, right? So unfortunately, people do get divorces or spouses pass away. Beneficiaries do need to be updated. And so we help them take care of all of that. And the good news is, again, John, through COVID, it's never been easier. A lot of times they can just log in and quickly change that stuff where you used to have to print it out and sign it. But from an ongoing basis, the life and DI, those are really policies other than increasing like a DI policy limit down the road, where you kind of set it, and then as long as everything's running the way that it should be, you are supposed to just be able to kind of forget it, keep paying it, and review it when you need to. But it's one of those things where you're probably going to have it for a longer period of time.
So when we were still doing insurance, kind of like towards the end of 2019 and into 2020, and we didn't have a great way to do this because we weren't fully digital at that point, Tommy. We still had a lot of paper files, but insurance companies started issuing electronic policies, right? So you would sign up for a 30-year term through Lincoln. You would get that. And instead of getting a physical policy in the mail, they were now sending you an electronic policy, and then relying on the client to save that on their iPad or wherever, and probably, like, calling it out, it's probably a substandard filing system, right?
Yeah,
most people
sure.
aren't that organized. How are policies being issued now? Do you guys store them? Is that burden all on the client? I just am kind of curious how all this is working now.
Yeah, that's a great system. So we set up what we like to say is like a foolproof system, right? So we have a copy of the policy. We have reminders in our own system, so we don't rely solely on the insurance carrier system. And the advisors have a copy of the policy. So when there's a policy coming up for renewal or a payment needs to be paid, we're in the loop, the client's in the loop, the advisor's in the loop. And then most of the time, the insurance carrier is also sending reminders via mail, snail mail, right? And then they're going to get email reminders. And then in terms of storing the policies, it depends on the carrier. And a lot of the times the clients actually have the choice if they want to have a paper copy, if they want to have an electronic copy, or if they want to have both. So we've tried to set it up to where if you miss a premium payment, or you've got 30 days until this policy lapses or cancels because of you didn't pay it, it will not be because we did not try to almost beat your door down reminding you to pay that premium. Because the last thing that we ever want is, for someone not to be able to get a policy back or a policy to lapse that they really need for their families.
All good stuff. Yeah. Where next, Tommy? Where do you think we should go next?
Well, it's, the service model got me thinking really the question of like, well, why did you decide to do this? And maybe as we talk about that, one of the things somewhat backpedaling, but looping it in as well, was fiduciary and, versus an agent, and maybe just explain, because I thought it was great. You said, hey, audience, you should know the difference between independent and captive, meaning that I can shop everything, but still kind of explain what is an agent, as well as why did you and Peter decide to do this?
Yeah, right. So an agent, broker, agent's usually used as a term for someone that has their insurance license, right? Insurance agent, right? So that's kind of a general one. Or a captive agent would be somebody that works solely at a company. And the way that I always kind of explain that is, they're coming to you trying to sell you on why one company is the answer for all of your problems, right? And so there's a lot of companies. Maybe you've talked to somebody that called you and set up a meeting and only wanted to talk to you about one company, if you're listening. And then a broker, they're kind of showing you all these different reasons as to, here's your options. Here's the good thing about going this way. Here's maybe the benefit of doing this a little bit differently. And so I just think it's better to work with a broker. There are still some brokers absolutely that are going to try to pitch you products that maybe you don't need. So you always be careful. And I always say, just kind of have like your common sense meter on. And if it feels too salesy, or you don't feel like there's a good justification as to why someone's recommending what they are, go back to Tommy and John and ask them what's going on there, because they'll have the right answer for you. But in terms of why we got into what we did and why we wanted to work with people like you guys, I started my career at a captive company straight out of college, where it was kind of like there was one solution that fit everybody's needs. And it was like, get out there, go sell it. And sometimes I'd come back with a term policy because I thought it made sense for the client, term life insurance policy. And the question that I would get would be like, well, why didn't you sell them a permanent policy? You're going to make a lot more commission off that, right? And I was like, huh. And then like after the kind of like newness of it wore off, I was like, I don't really feel like I'm doing the right thing here. Like I don't really go home after I get off of work and feel like I'm fulfilled by what I'm doing, right? And furthermore, it feels like I'm being pushed to do something I actually don't believe in. And so I was going to leave. My whole family's in the medical field. So I thought, maybe I'll go get into some sort of medical device stuff or pharmaceutical. And my business partner said, well, hey, man, I think there's a cool market that we could serve. And he told me about the fee-only financial planning community. And I was like, wait, so you mean that like they could do all the financial planning, they do a good job, their recommendations are going to be in the best interest of the client because they're not compensated for it. And all we have to do is do a good job of working with them and implementing these things. And he was like, yeah. I was like, well, that sounds like a win. And so we kind of came up early on with the analogy. It's like the financial planner is the doctor of the financial plan, right? If they see a prescription that needs to be written, they write the insurance prescription and then BC Brokerage fills it as long as everything looks good. And so, that's why we love doing what we're doing now. And it's so cool to work with so many advisors that truly believe in helping their clients. And we like to be a small part of helping out there.
I love it. And that's what a great analogy. We probably got to spend some time drilling into term. Even it's probably one of the most boring, but also critical, life insurances out there. And sure. John and I kind of always wonder, tongue in cheek, what do you get out of a term policy? And perhaps it's the more comprehensive service and filling in other areas of need. But is there any money in selling a term policy?
Good question. So let's start with what is a term policy. So the easiest way to think about it is it's a life insurance policy that you have for a set term. So a period of years, right? So 10, 15, 20, 25, 30 are going to be the most common types. Well, there are some other companies where, they go up over time, but let's keep it simple. 15, 20, right? And then you have a certain amount. So say that you have a 30-year policy for $1 million. That means that, maybe what your payment is or your premium is $60 a month. What that means is every month for the next 30 years, you pay your $60. If something were to happen and unfortunately you were to pass away, $1 million is paid tax-free to your family, right? So that's really what it is. If it's for 20 years, same thing, except for instead of 30 years, you pay it for 20 years. And so that's a really good way during your peak earning years and when you have a family and you're going through all these times in life where your human capital and your ability to earn income is a lot higher. It's great to have a term policy. As you move closer to retirement, realistically, your need for life insurance should slowly start to diminish because you're building more actual assets that you can live off once you get to retirement. So, did you have something, John?
Yeah, you have to steal our saying.
Mm-hmm. Yeah.
If you can afford to retire, you can afford to die.
Yep.
And it's very blunt, but it's like exactly your point is you spend this entire career accumulating assets, building a social security, for our clients building a pension. And if you can afford to retire, chances are, you can afford to die. So we overwhelmingly have been, replacing federal employees group life insurance option B with a 10, 15, 20-year term for 30 years. Like that was a way that we would do marketing. We would find somebody who was 45 years old, help them replace FEGLI option B, meet with them every year for an annual review. Then one day they're 59 and a half and they have over $1 million in their TSP.
Right.
And then that's when we really solidified, the ongoing relationship. So if you can afford to retire, you can afford to die. The reason we say that, audience, is because we're also huge fans of electing full survivor benefits at retirement. So Broc, you probably are aware, but if somebody were to have a $50,000 federal pension, at their death, the spouse is going to get 50% of that.
Yep.
So $25,000 or $30,000 SBP, that is their permanent life insurance.
Yep. Yeah, we work with a lot of veterans, so I know exactly what you're talking about with the SBP and electing into that and doing it. Yeah, for sure. And to answer your question, Tommy, I'm not going to dodge you, man. I'm happy to tell you how much we make on a term policy. I always say, given what we do, I think we're the most transparent insurance brokers in the world. If you find any that are more transparent, let me know, and we'll try to figure out how to be more transparent. But typically what you're going to make is between like 80 and 120% of the first year commission, right? So or the first year premium. I'm sorry. So like if a client were to pay $1,000 for an insurance policy, typically we're going to make somewhere between $800 and $1,200 on that their first year.
Okay. Yeah. So you got to do a lot of volume of term policies in order to make a business work with that. But that's not your sole business. So that's my guess. This is just one piece of how your business operates.
Yeah, absolutely. One piece of how our business operates, and we're super blessed that we get to work with a lot of people every year. So I would say we're definitely from a monetary standpoint, volume based over selling people giant whole life policies or something like that. Yeah.
Well, that's good.
I
was just thinking, John, we'll probably have to do other episodes in the future because there's so many insurances we can dive through with Broc from an educational perspective, like you just threw out whole life. But I don't know if we have time for that today.
Yeah, no.
And I didn't mean to cut you off. So
have me back. I'm happy to come chill with you guys anytime.
Yeah, we'll definitely do another episode. I wanted to come back real quick to agent. And I think it's important for the audience to know, guys, that as an agent, your loyalty is to the insurance company that you represent, is not necessarily, or definitely isn't, to the client. So that's an important distinction between like agent and advisor or agent and fiduciary. I personally believe that people like BC Brokerage, although acting as an agent, you are effectively representing the insurance company. I believe you can do that and still hold yourself personally to a fiduciary standard.
Yep.
But that also may be a unicorn that does that. So you have to understand that the loyalty is with the insurance company. Hopefully we can introduce people to people like BC Brokerage and Broc, who maybe they can't call themselves fiduciaries, but then try to hold themselves to a fiduciary standard regardless. And that's where we hear, Broc, when you say things like, I needed to sell permanent life insurance to get my health insurance, or I needed to sell permanent insurance to make more money, or I needed to sell permanent insurance because everybody was telling me I should.
Yep.
You made the decision that you wanted to start your own business because you wanted to operate, at least what I'm hearing, as basically a fiduciary agent if something like that were to exist.
Yeah, I mean, I wanted people to have the insurance that they needed, not just what the company wanted me to sell them. Mm-hmm. Right. And there's all these incentives, and like you go to some of these conferences with the insurance agents and you're like, did I just walk into a circus? Like, where am I at right now?
Yeah.
Because it's ribbons literally from their, I always joke, it's ribbons from their custom suit lapel all the way down to their Ferragamo loafers, because that's what everybody is wearing for some reason. And it's like all of these ribbons are based on how much you can sell and what you did. So like how much term that you converted over to permanent and how many lives you wrote, which is policies you wrote. And then on top of that, even if you're working with a broker who seems like they're trustworthy and honest, always ask good questions, because there's always people that are incentivized by, if I just write X amount more with this company, they're going to send me to a trip to the Bahamas. Right. And so ask those good questions, right? Ask them how much they're going to make on this one versus this one. Ask them if you can, get a second look on the policy. And I think just ask good questions. And like I said, use the common sense feature that your brain gave you.
John,
one of my favorite movies, Tommy, is Groundhog Day.
Yep.
And there's Ned the Head Ryerson, who, is selling a single premium whole life in 1980, to, I forget the guy's name, Bill Murray. But insurance has really changed over the last 40 or 50 years. And what I mean by that is there was a lot of sales training, Broc, before. There was a lot of people who would come out of school, go into insurance sales. They have a very good sales training program. People were knocking on doors and selling insurance policies. And my hypothesis or my belief is that more people were probably adequately covered with insurance 30, 40, 50 years ago. And then over time, insurance has gotten such a bad rap. Mm-hmm. And then so many firms like us have completely exited the sale or the marketing of insurance that I believe there's probably a pretty drastic underinsured issue in this country.
Yep.
I don't know if we can actually put our finger on that statistic, but anecdotally, I think that people are probably underinsured where they should be because there's not as many salespeople anymore.
Yep.
And then you have a lot of people graduating from Virginia Tech or starting their fee-only RIA who don't put a premium or don't put enough effort into the insurance component. I really believe that BC Brokerage is helping satisfy both of those, the potential underinsured crisis, which could be there if we could get some stats on it, as well as maybe the underserved, who are not getting or who don't have the insurance expertise. Like, we're very fortunate here to have Mike and Ken, who grew up in the insurance agency world, me, who lived in it for 14 or 15 years, Tommy and Ben, dedicated to it, even though they maybe never sold a policy. A lot of fee-only financial planners are probably underserving from an insurance standpoint because they never lived in that world. So I think you guys are doing a lot of good.
Well, that means a lot. I appreciate that, John. And to add a layer onto that, man, I would say also the misinformation that's out there, right? So there's never been more access to misinformation. So you have less people securing less good coverage, right? And then you also have less people wanting to go in that because it's a tainted industry that's not, viewed in the best light. And then you have 18-year-olds on TikTok that are talking about the cars that they're driving from selling certain types of life insurance policies. And so there's like, I mean, the amount of times that I hear people that are getting out of the military or, that have just kind of done what they were told because that's kind of been the option up to this point. Now they finally have to get a private policy, and they're asking me about a type of policy that they saw some, forgive me 18-year-olds, but like some 18-year-old with a trendy shirt and the broccoli haircut, right? Selling them like this IUL or whatever it is on TikTok. And I'm like, that's not what you need. Don't worry. Here's what that is. Here's why you don't need it. And so totally agree with you, John. It's a huge problem with the industry reputation, not as many people getting into it. And then also the people that are just telling people the wrong thing to try to make a buck.
I gotta say, when we get some more marketing firepower, guys, we've got so many powerful visual images you guys have been conjuring up. I was like, it'd be so cool to throw on screen the broccoli head right now, that I want to see like an AI generated image with like the ribbons going down to the floor. It just would be hilarious to throw those images up. And Broc, I think it's great what you guys are saying. The dichotomy, the extremes here of don't trust it, completely underinsured, to the other end where it's just make believe land and just nonsense being put out there. And even I anecdotally bounced something off Broc recently because I had a case where somebody was like, power of zero, or somehow I'm going to do this retirement income plan. And I was like, they're not sharing with me exactly where they're getting this information, Broc, but here's my read of it. You're in this world more than me. What's your thought? And he's like, yeah, that's exactly it. And here's like what's going on. So having like sources, credible, trustworthy places you can go, and coordinating it all is extremely valuable. I love the specialization that we all bring. Your analogy is great. You guys be the doctor, specialize in financial planning, identify some issues, and then I'll be the specialist filling the prescription. And a pharmacist still checks a doctor, right? And that's kind of as I thought about this analogy. You could still be like, hey, did you really think about this, guys? Because I see some potential problems here.
Yeah, he was like, I don't know why you're prescribing a painkiller for a stubbed toe. Like, we gotta talk about this, right?
Exactly.
So, yeah, no, for sure. I mean, we definitely are reviewing it, and there's been times where we've pushed back on the advisor. Like, have you thought about this? Like, a good example, for you guys would be like laddering term policies, right? Where they're like, do this one for 10 years and do this one for 20 years. And we're like, well, based on the amounts and the client's age, do you know it'd actually just be cheaper if you did the entire amount for 20 years, just based on policy fees or whatever it might be? And so, we always think about the fact that the advisor has a lot more access to information and a comprehensive and overall view of the financial plan, right? So we're always thinking about that. And that's what we love about it, right? That's why we love to do what we do. But with that being said, we always ask if we have permission to have a partnership with the advisor, so that if we ever see something that maybe the advisor's not, or there's a new development in the insurance world, we can come back to the advisor and say, well, hey, what about this? What are your thoughts on this? We might recommend this here. And a lot of times, we kind of meet in the middle, which is awesome.
What I'm hearing is just professional respect. And we completely agree. We respect that you live and breathe in that world and are far more aware of what's going on. So we want your opinions, and you're respecting that we have a deep relationship and can see a bigger picture. So yeah, I love it. And that's the way it should be.
Absolutely, man.
I smile when you talk about the term ladders, because the textbook answer is a term ladder, but then, then you start like zooming out once you've done this for a period of time and you're like, well, inflation is going to eat away at this life insurance policy anyhow. Yep. So if I sign up for a 20-year $1 million policy at 30, by the time I'm 50, that's only worth 500,000. So are you really getting any bang for your buck by laddering these? Again, it's like penny wise, pound foolish. And I also wrote down, it's okay for life insurance or insurance in general to be boring.
Yep. And
so much of what happens that you see on TikTok is, like you said, the power of zero or IULs or these magic bullet products, basically. Like an insurance product is not going to help you retire. It's not going to solve 30 years of bad decisions in an instant. Right. Insurance products do what they need to do, and it's okay for them to be boring. There are reasons to have IULs, VULs, variable annuities with riders. All of those have a place in a financial plan somewhere. But generally speaking, I think we're probably all three of the assumption that the more boring the insurance is, the better.
Yeah,
it satisfies the need it needs to satisfy. And then you let your other dollars go into Roth IRAs, HSAs, 401ks, rental homes, whatever you want to do. But kind of keeping the insurance more boring. I think people make a mistake, Brock, in that they want to like justify what they're doing. So it has to be like sexier or something. It's like, I don't just want to waste money on term, so I'm going to supercharge my term or something, because it needs to sound better.
Yep. Yeah, and you can always tell where those people come from because most of the time they heard it from somebody that's calling a product something it's not. I remember back in the day when I was early on in training, there was this guy that we heard about that would call life insurance STAR plans, STAR, right? And it was strategic tax advantage retirement account. And it's like, no, it's not. It's a life insurance policy, man. And he got hit hard with some fines, but it's like, you're exactly right. When you have people out there calling certain types of life insurance policies Roth IRA on steroids, or they're using hyperbolic statements like, we're going to supercharge this thing. It's like, all right, man, like you didn't create the wheel. This thing's been around for a lot longer than you've even been in the industry. And somehow you went and got your life and health license in a few days, and now you're like the expert on the subject. So no, I couldn't agree with you more, man.
Well, guys, I say we have a few questions, Tommy, that maybe we could do some, sort of rapid fire questions for Brock, maybe wrap up with some action items, and then get another one of these episodes on the books probably.
Yeah, I think it sounds great.
So, Brock, one question I have is the cost of insurance. How has that been changing over the last? I've been in the industry 15 years, and my belief is that insurance costs have come down, at least as it relates to life insurance. My other thing is the cost of long-term care has skyrocketed.
Yeah.
Can you share just briefly with the audience trends that you're seeing from like a price standpoint, whether it's on life insurance or DI or long-term care?
Yeah, absolutely. So we've definitely seen term kind of go up, and then we've seen it come down. As a general rule of thumb, term is very affordable. Like if you look at a policy for a relatively healthy person, it's very easy to obtain. Big pain point in the insurance industry with long-term care is you're seeing policies that were written in the early 2000s that are basically, people are getting letters in the mail saying your premium's going up by 30%. And so long-term care is definitely one of those things that's become more expensive over the years because they were kind of trying to price them very affordably back in the day to get people to buy them. What they didn't know is that they priced them so well and made the benefits so good that they actually designed a horrible product and then had to retroactively go back and start raising the premiums on people. And then for a DI policy, you can count on the policy being 1 to 3% of your gross income, depending on how risky your occupation is. If you're like an accountant, maybe that 1%. If you're an underwater welder or somebody that can get it, I don't even think you can with that one, but that's probably going to be closer to that 3%.
It's and I think anecdotally, I was just going to say on those long-term care premiums, recently got a notice for a client, Genworth, one of the big long-term care insurers, 80% increase.
Yep. Nasty. Now, I want to nail down on that real quick because if you're listening, you'd be like, that means I should cancel. Talk to your financial advisor, talk to a good insurance broker, because if you do need that policy, all right, and you're getting close to, you might need it or you're going to need it within the next 5 years, that policy might have a lifetime benefit. It might, it might have a very generous monthly benefit that it pays out. And if you were to go out into the open market right now and try to replicate that policy after you bought it 20 years ago, you're probably going to be paying more for less benefits that are a lot more limited. So
I love that you put that out there. 100% correct. Mason Associates or nobody on this podcast was suggesting that just because the premium's going up that we just get rid of the policy. That was not the advice the client got. It was let's dive into this, see what our options are, what's the best way to manage this.
Totally.
Yeah. So we're on the same page.
Yeah, it sucks sometimes when you're biting the bullet a little bit, but you're like, man, I don't want to pay for this. But
I'll tell you,
it is an important thing to analyze it rather than just coming to a big conclusion like cancel it.
It is very frustrating. It is part of our job, although sometimes it's a little annoying when I sit here. I'm like, I didn't sell this policy, but here I am servicing it and trying to figure out what's whoever in my mind, perhaps I'm wrong. I'm like, whoever made this commission is long since gone, and I'm here dealing with this. But that's the client's plan. That's what we're here for, and thankfully, we also have your firm to lean on to help us in the analysis.
100%.
2 quick hits, guys. Long-term care, if you're getting those letters, audience, whether it's federal long-term care or private sector, they're giving you 1 to 3 options, but there's typically more options that you can special request too. So we do a lot of that with Genworth. We're like, hey, thanks for showing us what you thought we wanted. Here's what we actually want, and we're able to modify these and keep the premiums pretty similar. Folks who had a 5% inflation rider in 2010, maybe we can drop that inflation rider back to, from 5% to 3% or 5% to 1%. Maybe we could, things that I don't really want to compromise on are things like elimination period. A lot of these options that come out from insurance companies are like, increase your elimination period for home health care from 0 days to 90 days. Well, no, because that's going to, disproportionately increase my likelihood that I don't get to use this policy.
Right.
So that's why you need somebody that knows what they're doing, because I'd much rather monkey with the inflation rider than I would the elimination period and that time deductible. And then another action on the life insurance, term life insurance would be if you're young-ish and still healthy, or you got more healthy recently, reshop your insurance, right? So for me at 37 years old, I could probably go back to when I was 32 and look at that $2 million term. And I could maybe buy another 30-year $2 million for almost the same price that I bought that policy 5 years ago. So what I'm able to do is relock in that policy, extend it another 5 years for a similar premium. And that's going to do things like extend my conversion privilege. It's going to insure me for a little bit longer. It's going to force me to go through a medical exam, which never hurts, So there's just stuff to be thinking about. Sometimes we can just get in a rut and we can get lazy. Firms like Mason and Associates and BC Brokerage would hopefully be able to help you guys think about that.
And John, to those points, what you just said too, kind of that sequence there is, shop it, get coverage in place, then get rid of the other policy. Because just think about what Broc said, we don't want anybody misconstruing what we're saying. And as you've said in a previous podcast, John, it's a license to shop. It's not a license to drop. Right.
Yeah,
so let's get the other coverage in
you
place.
guys are full of great sayings, man. I'm stealing some of these. You're going to see them around. And get it before you need it, right? That's the other thing I always tell people about term insurance is like, if you're young and healthy and you got the opportunity to get it and it's like $30 for $1 million term, you're like, but I don't really need that much yet, or I don't need it. It's like, great. That's exactly when you should get it because it's less than you're going to spend on like a cheeseburger tonight when you go out with your friends or whatever. So
don't let perfect get in the way of good enough. And that sounds like we're very much on the same page. I think John and I, or our firm as a whole, is usually, particularly for younger people, so just go get $1 million. You don't really need to overanalyze this. Like, just choose $1 million and let's check this off and go on.
Yep, exactly.
You're going to grow into it, right? If you're young, you're probably getting married. You may start a family. You're going to buy a house. All of a sudden you thought you were overinsured at $1 million, and you're going to wake up one day saying you need another $1 million on top of it. So what's going to happen? Yep. So definitely, I love that. Maybe 2 other quick questions. I have 3 questions. But hopefully they can just be rapid fire. Are Are hybrid long-term care policies like MoneyGuard and are those still a thing?
Yeah, MoneyGuard, One America Asset Care, very much still alive and well. A lot of people are opting to do those because number one, it's not a use it or lose it, right? So if you don't use it, there's still a benefit associated with it. It's paid out indemnity on an indemnity chassis. So once you qualify, some policies are reimbursement, meaning that you have to kind of pay for it, turn in all your receipts, and then they pay you back if they deem the expenses worthy of reimbursement. Whereas indemnity, it just kind of strokes you a check once you qualify. And then they can't raise the premiums. So I would say a lot of people that are purchasing long-term care now do like those policies a lot, but some people just like the traditional policies that are insurance for the sake of insurance.
So the life insurance component to those hybrid policies contractually obligates the insurance company to where they can't raise those premiums, right?
You got it, which makes the clients who especially are planning on having a certain amount of money and know what they want to be paying for something a lot more comfortable knowing that those can't be randomly raised down the road.
I think, and so this is a good one where we can always have clients coordinate with you. And I think I even reached out to you about something like this, I believe, was because it's a life insurance component to it, do we get to a point where, age is going to make this just kind of unfeasible?
Yeah, absolutely. So what I always tell people is like in your 40s, it's an insane deal, but you might not be thinking about it yet, right? In your 50s, still a really good deal as long as you're in good health. Early 60s still can be a pretty good price. Late 60s, early 70s, a lot of times, there's a couple of health considerations, and just based on the age, it can become prohibitively, too expensive for people a lot of times. So start checking it out earlier than late 60s and early 70s for sure.
Great.
Let's see. Do insurance company ratings matter? I know personally, when I look at this, it's like always pick somebody that's A or A plus or whatever, and Moody's or S&P or whatever the insurance ratings. Like, how much does that matter?
Best. Yep, all the one. Yeah, I would say it matters. We only use A-rated carriers because to me, like when I have a third party going in and opening up the books of these insurance companies, I want to know how many claims were filed versus how many claims were paid, right? And then I want to know after those claims were paid, how much money do you have in reserve? Because I want that to be a pretty healthy number. Because if you don't have a lot of money in reserve and you're paying out more than is sustainable for years to come, that makes me think about if you're a reliable insurance company. So I think the ratings matter a lot, and I think always work with a carrier that has at least an A rating.
Awesome. And my last question, and Tommy, if you have any, please fire away, is I think there's always this feeling that people are going to be taken advantage of by the insurance company. Our RV took some damage in February through a windstorm, and Safeco cut a pretty big check pretty easily. Every time I've ever had a home insurance claim or an auto insurance claim or any claim, I've never had any issue with these insurance companies paying, regardless of who it is. Now, granted, they're all A-rated carriers, but is it reasonable, or is it kind of an unreasonable fear that people have that if they leave USAA, for example, and go to Safeco, all of a sudden now the claims paying ability and the experience is just going to be so terrible?
Yeah.
What do you see?
That's a good question, right? So we all get into the trap like, this is what my parents did. This is my insurance company. Even as an insurance broker, before I did a different company, I was like, well, I've been with Farm Bureau all these years. This has been my guy. I know they pay the claims. Well, so do other companies, right? So don't worry too much about that. Go out and shop it out. I would worry a lot more about those things that we talked about earlier in the episode, like having the proper limits and maybe getting an umbrella policy, than I would the company not paying out.
John, awesome. I think we've covered quite a bit in one episode. I think we probably need to do this again, get another one on the books and hit some other topics. So I think I'm good on questions. Certainly if you have any others up your sleeve you want to make sure we get out there, or Broc, if there's anything on your mind you wanted to make sure you get out there.
I just want to thank you guys for having me, man. This has been fun. We try to make the insurance conversation as interesting as we can. So if you're still sticking around to the end of the episode, we appreciate it.
Awesome. Well, Broc, thank you. Tommy, thank you for another great episode.
Yeah, thank you, John. It's always great. And same to you, Broc. It's a lot of fun, and I do hope we do it again.
Likewise. Thanks, guys.
Is our content helping you make informed decisions? Do you feel more educated and empowered after listening to this episode? Have you made positive changes in your financial plan since you started following us? If so, please be sure to share in the comments section, share this episode and what we're doing with your friends, family, and coworkers, and send us an email to MasonFP, like Mason Financial Planning, at masonllc.net. Thank you for tuning in to another episode of the Federal Employee Financial Planning Podcast. Remember, we're financial planners first and we do this second. As always, we hope you leave this episode and every episode feeling educated and empowered to make positive changes in your financial plan.
The topics discussed on this podcast represent our best understanding of federal benefits and are for informational and educational purposes only and should not be construed as investment, financial planning, or other professional advice. We encourage you to consult with the Office of Personnel Management and one or more professional advisors before taking any action based on the information presented.